Okay, so welcome everyone. Welcome to Lunar Trade. Welcome to one of the longest video you're going to be watching on this YouTube channel because this is going to be covering everything for a beginner. Even if you don't know anything in trading at all, I mean anything, you've never heard of it, this is for you. If you want to enjoy this video more, you should use a earpiece and just relax back and listen because it's going to be very long. At least it will be around 2 to 3 hours because it's going to be a full course on beginners for beginners in trading generally. So if I'm so slow, you can also use the fast forward button in YouTube. You can put it in S2 so you can listen it in a more fast way. But if you're like me that like to listen to every beat of when a person is talking, you just relax back with your earpiece and listen attentively. Now you should have have your book, your trading book. So this is the time you want to bring it out and start writing down. You understand? Start writing down. Start jotting everything I'm saying because I'm not actually going to be typing and all. I'm just going to be. The thing I text was what you can see on your screen. I just what I'll be talking about in this section. Now, the common question that I used to get from people is, who can trade and how much do I need to actually trade? First, who can trade? Anybody can trade as long as you are of the age, let's say 18 or so. Why I said 18, so you can have an identity card to create a broker account, a brokerage account. But even lower than 18, you can still learn how to trade. So anybody can trade. It's not for female, it's not for male, it's for everybody. Boy, girl, even your grandma and grandpa can also learn it. Now, how much do you need to trade? You don't need any dime. You don't need any dime. Nothing. All you need is your dedication to the market, your seriousness. Now, if you're serious in the market, you learn everything. You're good in taking trade. People are going to look for you. People are going to invest in you. People are going to give you that money that you need to trade if they can see that you are good and you have a proven track record. Now you can ask, how will I get track record? You can get track record by actually doing this every day, showing your analysis, doing live analysis on the net, on the internet, just putting yourself out there. If you don't have any money, then you can start with as low as even $10. Yeah, we're in Nigeria. So using a brokerage like SNES, which I use, I think the minimum is $10. So you can even start with that and start at least trading little by little as you're practicing. But you don't need any money. You've What you need first is learning the craft of trading, which is very broad. Not anyone can trade. A statistic that 91.7% of traders are not making money. They are losing. Do you understand? So it's only the 8 point something that are successful traders. So we have 91.7 unsuccessful traders. So you see how the gap is. So most of your mentors, they're actually lying to you. They're not trading. You are their product. So they merely teach to make money. You understand? They teach trading to make money. They don't actually trade. And that's a very big effect in the space. Why the space has been crowned the scam space. The trading space, whether forex, crypto, or anything, has been crowned a scamish space because of most people are not actually trading, they just teach, and you tend to go learn from such people because they show flashy lifestyle on the internet and you feel they are actually making it, but most of them are not. I'm not saying all are fake, no, but most, 91%, 91.7% are fake. So you see, you need to be careful where you get yourself involved in trading, or the person that you pick as your mentor to teach you. He may just know the chart. Now, what did I mean by chart? Know this. I know if you're new, you've been seeing this in different places, in different people, maybe on the internet. So this is called charts, candlestick charts. This is called charts. So they might know the chart, they might know the candlestick, but they don't actually trade. You understand? They are traders, they are analysts, and they are gamblers. So you need to be careful. So some people actually trade, why some people are just gamblers. They just gamble in the market. Why some people are analysts. They can analyze the market, but they don't know how to take it. They don't know how to take that trade, but they will analyze it for you. Be careful for those type of people. Those are people you want to stay away from. You want to make sure your mentor is a trader, is actually making money from the market, not making money from teaching people or selling courses. They just have some course and they sell it out. I might actually sell some course maybe in the future too. Just not joking though, but just saying. But by then I should have gotten to some stage in wealth before actually doing that. Not some brokey trying to create a course and selling it with faking his lifestyle. So you might not actually know the person that is faking it and the person that is putting it real. But it's good you should know the data that 91% of people are actually unsuccessful. So that being said, anybody can trade and you don't need money to to start trading. Yours is learn the craft, people will look for you. You understand? Now, we're going to be starting off with what is trading all about? When you hear the word trading, forex trading, crypto trading, what are they all about? It's very easy. You know, if you've heard of cryptocurrency before, you buy and hold. You just buy crypto, maybe Bitcoin, and you pray for it to go up so you can make money. If it goes down, you lose money. In trading, it's different. You're actually predicting parallel to the move if it will go up or go down. So if you are right in the move that you predicted, you make money. If you are wrong in that move that you predicted, you lose money. So if you predicted that um, the asset you're trading will go down and it actually started going down, you'll be making money. But if it reverses and goes up, meaning you're going to be losing money. Vice versa. So in trading, we're only trying to predict this movement, the down movement and the up movement. We're going to be talking about that more. So that's all you're doing. You're just trying to predict either up or down. You understand? Using this candlestick. Learning this candlestick, what they mean. You understand? With time, you're going to understand each of these candles. You'll be able to predict it just by looking at it, putting some lines, and delineating the chart. So with that being said, what are the type of traders that we have? The popular one that you know are what? The Forex traders and the crypto traders. But there are more. There is a synthetic traders. So those are the ones that trade on your boom and crash, your VIX 75, VIX 100, and the likes. We have the stock traders. Those are the ones that trade Apple stock, Facebook stock, Meta stocks, Tesla stocks. We have the option traders. Those one is mainly based on time. They buy options, put and call options. We have binary traders. We have arbitrage traders. Arbitrage. Those are the ones that mainly you see on your peer-to-peer. Then we have the derivative traders. And we have the futures traders. Now, with all the 9 type of traders that I just listed, they are all the same. One person, you can do all. I find it funny when people are separating, calling themselves crypto traders. I'm a crypto trader. I'm a crypto trader. I'm a forex trader. I'm a synthetic trader. No, you can do anyone. You can trade anyone. The meaning of forex trading stands for foreign exchange. It's just an acronym, foreign exchange. That is where the word forex trading comes from. While crypto trading comes from cryptocurrency, your Bitcoin, your Ethereum, your ADA, the likes like that. So you don't specify yourself as a crypto or forex or synthetic trader. You just call yourself trader. Because the main stuff is as long as you can learn this chart, just this chart, as long as you can learn the candlestick chart, how it moves, the meaning of it, as long as you can learn it, you can do any type of trading, the 9 type of trading I just named. So you can either be a crypto trader, forex trader, stock trader, option, binary, arbitrage, derivative, synthetic, and futures. You can be any type as long as you can learn this chart. So you don't just call yourself a crypto trader. No, you call yourself a trader. So any assets that they bring for you, you can analyze it and make money off it. Yes, it's good you should be a pro in one of course, but you should not diminish yourself to just that. With that being said, we'll be going to the third one, ways of trading. Ways of trading. If you see, I put in bracket technical analysis. So ways of trading is talking about how you can analyze this market. That's why I put technical analysis. How you can analyze this. This is called technical analysis. The chart, how you can analyze it. There are different ways you can do that. So we have the support. Number one. So you can write it down in your book. We have the support and resistance traders. So that's another way. So this type of traders, they use support and resistance to analyze this chart. We have the indicators. So that's another way you can trade. Indicators. There are indicators in TradingView. You can go check it out. Now there are patterns. It can either be chart patterns or candlestick patterns. That's the third one. Then we have the harmonic pattern. Harmonic pattern, which in brackets is the Fibonacci ratio and sequences. Then we also have Elliott wave and algorithm trading, which is high frequency trade in brackets. Then the last but not the least is the SMC/ICT. SMC/ICT, which SMC stands for Smart Money Concept, while ICT stands for Inner Cycle Trader. SMC and ICT is what people call price action trading. So ICT is like an advanced SMC. You understand? ICT is like an advanced SMC. So with that being said, I'm based on ICT, which is like the most advanced type of way of technical analysis. Is more broad and people actually run away from it because the stress you have to go through in order to learn it. Most people just settle for the indicators, the patterns, support and resistance, and the likes because they are more easy, or they just tend to push themselves further to learning the SMC. But learning SMC just will reduce your win rates. You want to really be able to delineate the market in a way that you understand what is going on, you understand where price is going next. Because I said what? You're trying to just know the next move in price. Where is this candle going? Is it going up or is it going down? How to predict that? That is all what you're doing in trading. So the most advanced way in order to analyze that is called ICT. Now you can also make money in the other ways that I just listed. Some people make millions, billions from it. Understand? They're the lucky ones. You can be part of them too. But I'm not based on that. I'm based on ICT, which has made me a profitable trader. Give me opportunity to pass prop firm and live a stable lifestyle. So with that being said, we'll be going to the next one, which is form of trading based on time period. So there are different type of traders that specify when and when they want to trade. So the forms of trading based on time period are divided into three. We have number one, the intraday traders. Now, this intraday traders is divided into two. We have the scalpers and the day traders. Now, what's a scalping? Scalping, 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 they scalp the market from the word scalp, meaning these traders, they stay from, let's say, 1 minute to 15 minutes in the market and they're out. So they don't waste time predicting this move. They just predict it in just 15 minutes range. So from 1 minute to 15 minute range, they're out of the market. They're done. They're done predicting. So we have day traders. Day traders are from that 15 to 24 hours. So in a day range, you understand? Those are the day traders. Now, those two I just named, they are under what? The intraday trading. Now, the second one is swing trading. Now, swing trading is anything above 24 hours. That's a full day. So if you're holding a trade to the next day more than 24 hours, meaning you're swing trading. Now, you can also do swing trading. You can also go for like 48 hours. That's 2 days. You still swing trading. You understand? Now, the last one is called positioning trading. So they position themselves. So this lasts anywhere from 3 days to a week, month, even years. These are the long-term traders. They hold it for long term. They're not in any watch. They hold the trade for long term. And the next one, which is the fifth type of analysis. Type of analysis. That means forms in which you can analyze. Okay, I'll start with the second one, which is technical analysis, which is what we've talked about. Learning this chart. We've talked about it in number 3, technical analysis. Learning this chart. So I name about how many ways for you guys? I think 7 or 6. The ICT, the support and resistance, those are what the technical analysis is talking about. Learning the chart, analyzing the chart. The second one is fundamental analysis. Now, fundamental analysis is learning the news, how news affects the market. So this type of analysis is you don't actually need your chart. You just need to know how to analyze news that is related to that asset that you're trading. So there are sometimes that news comes out and it affects the assets you're trading. So how to analyze those news is what brought about fundamental analysis. So learning the global rates, learning the interest rates, and let's say different rates in the market. News, anything news, monetary policy and the likes. So if you want to really be a pro in fundamental analysis, the secret is you have to start reading about, know some finance terms. You have to start reading books on money and how money works and how the world works relating to economics generally. How money move, the banks, interest rates. You want to learn all that and how it affects the market. If you can invest your time in that, you'll be a pro in fundamental analysis. I have some books I can recommend for you. You can always DM me. My details are going to be in the description, or you can just go on my YouTube handle. There is the profile, and you see some links that you can use to reach me. I can show you some book in order for you to read and have some substantial knowledge when it comes to fundamental analysis, so you can analyze the news as soon as it's coming out or before it comes out, so you can know what to expect. Now, the last and my most favorite one is the psychological analysis. This is what differentiates you, that you're actually trading. There's a trader that differentiates you from an analyst and a gambler. Now, an analyst just know how to analyze the market. He's not a trader because he doesn't press the button. So it doesn't have anything to do with psychological analysis. Now, a gambler is a gambler. They're reckless. Psychological analysis gives you that difference. They don't have psychological analysis. They can't analyze the market. They don't know what risk management is. They don't know what account management is. They don't know what trade management is. They don't know the meaning of that because they just gamble. The technical, they don't actually press the buttons. They just talk on technicals, which is the chart. But a trader has to have a psychology in place. So he has to know risk management, account management, and trade management. So psychology is the most important thing, or the most important aspect or analysis when it comes to trading. Without your psychology in place, you can't make money in the market. You can't. Even if your fundamentals are top notch, your technical is top notch. If your psychology is not top notch, you're going to fail. So if you see I wrote 15%, 5%, and 80%, when you sum that up, that's 100%. So if you can have her, you have 100%, means you're good to go. Like good, you're literally a god with a small g. So nobody can get there because you can't have full psychology. You can read all the books, you can learn all the analysis, but you can't have full psychology. I think only God should be able to do that. Having 80% psychology. Now, with what I wrote, you see that if you even have full fundamental analysis and full technical, which is 20%, that's below average. That's F9. So you still be losing. And most of these people, your mentors that are teaching you in the market, This is what they do. They only know technical fundamentals. They don't know anything about psychology, and that's why you're losing money. That's why what? You're losing money. They know nothing about the market. Now, it's only two traders. That's the 7% that are making money that has their psychology intact. Psychology is way, way broad. So broad that even me as a successful trader, I'm still working on that. And I'll work on that till I die. It doesn't have an ending because your psychology can be fucked up at any time. And anything can mess with your psychology. Anything. That's why it's so broad. And that's why it's so confusing. Your personal life can affect your trade. If you're not having peace in that relationship that you are engaging in, it's going to affect your trade. This is why some people have been trading for years and they're not seeing any changes. They're not making any money. So they result into scamming others, taking money from them, teaching them, and they're creating bad offspring. So people don't know that what is wrong with them. The psychological analysis is not in place. Their relationships are not in place. I mean physical relationship. That means your relationship with your boyfriends, relationship with your girlfriends, family relationship, your environment, is it at peace? Are you at peace with yourself? Those are what psychology is. How many group are you in? Because you're a trader. On your WhatsApp, you're on like 15 groups, trading groups. On Telegram, you're like on 20. You have 500 mentors. How are you going to make money in the market with all those information coming in different ways? This is the main thing that is affecting the youth of today's. Because they are overdrive with information. So they don't know how to handle it. They don't know what to do with these informations. And that's what is fucking up their psychology. In terms of life and even in trading. There's a lot of information out there. You're gonna fuck up yourself if you're trying to just feed off everything. Now you know so much, but you're not making money. Because your psychology is fucked up. You wanna work on that? Get yourself out of those groups. If you have interest in one, just pick one. It might be my group, it might not. If my group is part of the group that is distracting you, take yourself out. I'm not in any group when it comes to trading. When I started, I was on my own. Because before I joined trading, I already tend to do extensive research. I have OCD, so that brought about it too. So you want to be careful about that. When you get yourself involved, what you consume. You do analysis on news, and when you come online, you go on Telegram, you check like 10 groups. They are all analyzing another different stuff. You're clothing your brain, you're feeding your brain with rubbish information. You're not going to be concentrated. Your mentors are giving you different ways in order to trade. Bad. All these bad. Pick one mentor, pick one group, and stick. Improve. if you want to make money from this market, it's all depend on you. As they used to say, it's OYO, on your own. It's on your own. Nobody can turn you into a successful trader. I can teach you analysis, I can teach you fundamentals, but I can't teach you psychological analysis. You have to go through that on your own, through failing, through losing money in the market. As I say, paying the market. You have to pay school fees, something like that. Those are the school fees you have to pay. Still striving and sticking to it and trying to look for learning from your mistake, where you go wrong, trying to take note of that. These are the things that you need. These are the things that you need to do to change. Now, in order not to take our time, because I can say we've been long, we still have a lot of section to go. As I said, this um um one this video will be long, so let's cut it here. Because if we're going to be talking about psychology, I can spend 2 days talking about it. 2 days just psychology, because it's the ingredient that people don't have, that the 91% of people don't have. The 91% of unsuccessful traders don't have. So with that being said, we'll be going to the next section of this video. Okay, welcome back. So in this section, we're going to be talking about psychology tips. Psychology tips. One of the most important topics. You need to put your heads down and listen attentively if you really want to make it in this space. The number one psychology tip I'll be giving you guys will be unrealistic expectation, or you should set realistic expectation. So in the trading space, people used to set unrealistic expectation for themselves. You want to be cashing 200 pips every day, 100 pips every day. You want to flip $10 to $100 every day. You want to flip $100 to $10,000 every day, because that's what you've seen in the space. That's what you've seen outside. That's what you've seen in the net. On the internet, you feel that is how trading is. Those things you're seeing on the internet are bullshit. Trading is not like that. You don't just come in the space and wanting to flip account or make quick gains just like that. No. It takes time and it takes step by step. So you have to set realistic expectations. So let me give you an example of realistic expectation. Having making 4% of your trading account in a month, that is still realistic expectation. Making 5% in a month, still realistic. So on the extreme end, let's say you're making 8% in a month. That's good. But that is still over leveraging. In a year, if you're making anywhere from 20% to 25% in a year, 20% to 25%, I'm saying in a full year, you're good to go. People are going to look for you. Now you'll be like, wow, that's so small. even the stock market makes nothing less than 7 to 8% yearly on average. The biggest hedge fund makes 18 to 19% yearly. So if you're making from 20, anything greater than 20, you're the best in the market. If you can do that consistently every good year, you're going to be a billionaire because people are going to look for you. I told you, I'm going to teach you how to trade professionally, not like all those junks you see out there. Now you want to set realistic expectations. Stop setting unrealistic expectations for yourself. Number 2 is keep a trade journal. Have your trading book, have your playbook, and have your journal. There are 3 different stuff. But if you're just starting, you can just start with one first. Have your journal. Very important. You journal everything you do day in, day out when it comes to trading. You understand? Then if we're talking of playbook is simply talking about when you're in the trade. What was your experience? That's another journal on its own. So another book entirely on its own. So anytime you put in a trade, you bring that out. What am I feeling now? How am I feeling towards this trade? Did I over leverage? Did I went all in? Did I use proper VIX management? That's what the playbook is going to contain. But your journaling, that's going to contain what time you entered, what time frame you entered, what style you used to enter. Was it fair value gap? Was it further block? Did it read? You need to journal all that. What journaling does for you is it's going to show you your strength and your weakness. So you feed more on your strength in order to make more. So when you journal for like 6 months and you go back and look, you're going to see where you're good at. 6 months is even much. You can journal for just 3 months. Steady every day. So you always journal. Then after sometimes you go back and look at this. Look at the data that you have in front of you. You're going to see your strength and you're going to see your weakness. And you want to work more on your weakness and feed more on your strength. Now, number 3 is no one trade should make or break you. You see people on the internet, or most traders, they just take one trade and they're all begging and crying and be like, go up, pump, please. That's not trading. That's trash. Oh, I took one trade and I lost on my account. I blew my account. You're not a trader. You're a gambler. That's gambling. No matter the trade you're taking, it shouldn't make you or break you. So you should make sure you're looking your trade in a long frame. So if I take 50 trades and I'm out of those 50, I have 35 win and 15 loss. Isn't that good? If I have 30 win and 20 loss, that's also good. I'm above average. So I'm profitable. That's how you want to look at trading. Not just the first trade you're taking and you're shaky. You're risking about 5%, 10% of your account. Some people even go as much as risking 20%. You don't do that. The highest percent you should risk max. Let's say you want to be all crazy. It's 2%. Yeah, 2%. Don't go above that. 2% should be the highest you should ever risk in any trade. So if you're going to be trading a prop firm, a proprietary firm, the highest you should risk should be 1%. Then after you lose, you cut that into half. That'll be 0.5. So no one trade should make you or break you. Your trading should be, your winning should be with the accumulation of so many trades put together, not just one. Do you understand? Number 4 is maintaining low leverage. So while talking, I think I've chipped that in. So maintaining low leverage is first, don't go above 1%, 2%. Your lot size, you need to know the account that you have with the lot size that you're going to be using. So in the further videos, I think I'll be talking about how to use your calculator, your lot size calculator. That will help you, give you the best lot size you should use when calculating your trades, or when taking a trade, sorry. So it will help you calculate it. You don't have to use your brain. Some people just go in and put different type of lot size. If you don't know the meaning of lot size yet, don't worry, just watch the video to the end. You're going to know the meaning of lot size. Then you can come back and watch this. It's better you watch the video twice. That'll be great for you. So as I was saying, maintaining low leverage. Some people over leverage in just one trade. That's crazy. You don't do that. You make sure you maintain a low profile when it comes to trading. Now, back test and forward test. Okay, there's something specific about back testing that people actually do wrong. If you know the meaning of back testing, it is using past data, that means the candlesticks, the history ones that are formed, using that and practicing what you learn. Then forward testing is watching it play, like tape reading. It's called tape reading. So watching it play and you just do your analysis with it. You're not taking trade, you're not typing the button, you're not placing any trade. You're just looking at the chart form. The chart's just talking to you. So that's forward testing. Now, one mistake I know people make in back testing is they just back test without time. They don't involve time while back testing. That is wrong. While back testing, you want to make sure you're back testing at the right time. So if you're going to, let's say, January 2nd or so, you make sure you're back testing at a certain section. Is it New York? Is it London? Is it Asia? You make sure you're back testing at the right time in which you trade normally. Now, avoid demo account. I think I've talked about this before. Demo account is going to fuck your psychology up. That's why it's created by all these brokers. Brokers, and what is a broker? Or who is a broker? A broker serves as an intermediary between you and the assets you want to trade. So, example of brokers are like SNES and IC Market. So, say if I want to trade gold, I don't know where to go to do that. So, broker gives you that option. You register, you sign in, you log in, and you can trade. So, broker is like an intermediary between you and the assets you want to trade. Any assets you want to trade. That's a broker. So, if it's in crypto, Binance is like a broker. So, me and I want to trade cryptocurrency, right? So Binance is giving me the service to trade cryptocurrency. So Binance is a broker too. Do you understand? So all these brokers, they put in demo account because they actually want you to lose money. When you lose money, that's when they make money. If you make money, they lose money. So they want you to trade that demo account. That's why they actually fix it there. So you can be careless with money. You understand? You just tap the button anyhow, and because of his fake money, That's what they call demo account. It's like a dummy. Just the money is just there, fake. You could trade it, you could see it going up, and you feel good. But no, it's fucking up with your psychology. Don't do that. You stay away from such thing. Anybody that's trading demo close to you, you just tell them to stay away from you because they're going to spoil your own thinking. You can advise them. If they don't listen, you trash them off. Don't, don't ever do anything with demo account. They should be your number one enemy in this trading space. Now, number 7, isolate yourself from different group. I think I've talked about this before. Stay away from different group. Stay away from different group. Isolate yourself. Isolate yourself. That's the most important thing. Yeah, you want to connect. They tell you all those trash. Connect so that you can learn new things. No. Yeah, connect with the right group, but know that 95% of traders are failures. They are unprofitable. So your chances of finding the right group is fucking low. So you have to be careful. If you're in my group, as I said, and you feel I'm the one distracting you from actually focusing on yourself, on improving yourself personally, get out of my group and go do your thing, boy or girl. So you want to take note of that too. The next thing you want to do is stay away from robot trading. Now, what robot trading does to you is it makes you lazy. Because what? The robot will be doing all the trading for you. So imagine you're already learning how to trade and you just have a robot that is actually just doing everything easily and making money. First, you can never be wealthy trading robot. I also have a robot. It's just for like, how will I put it? You should have multiple streams of income, right? Something like that. So it's just bringing extra cash in. But you can never be wealthy trading with robots. Never. No one has ever done it. If they tell you to trade with robots, no. They just trade by maybe selling it to thousands of people, the same robot. So you want to be careful with that too. You understand? Don't stay away from robot trading, especially at your early days. Why I'm using robot is because I've been in this space for 7 years and I'm addicted to the chat already. So robot is just like an extra cash. It still makes me lazy sometimes, as you can see. So I actually try to minimize how much I deposit in it. So just a little amount. So it doesn't actually change anything. It doesn't affect my lifestyle. It's not involving my cash flow and everything. It's just there. I'm just giving it a test. But stay away from robot at your early stage of trading. Stay away from robot. Now, I want to talk about the myth in trading. Different myths in trading. Like, some people feel the market is after them. No, the market is not after you. It doesn't even know you personally. It doesn't know anyone personally. It's run by algorithm. Programs. Program doesn't know you. It just know where your stop loss is. And it's going to chase it. Now, you actually doesn't affect the market. Now, me saying chasing it, I'm just joking. But it's not chasing your trade. You're like so you see like a big ocean, sea or something like that. You're like a drop of water in that. Tinier than drop of water. So let's say the ocean is the market. You're just a bit drop. That's what we are. The market is so broad that we don't have any impact in the market. So the market doesn't know you personally. You don't just know how to trade. That's why you feel the market is after you. So when you place a buy, the market goes sell. When you place a sell, the market goes buy. And you say the market is watching, you know it's not doing that. You've not just know the psychology of trading. You've not learned the chart well. You've not learned your fundamental well. So you need to do that. Now, if I said we are not actually doing anything, then who are the key players in the market? Who are the people that actually affect the market? Number one are your hedge funds, your institutions, your big institutions, your banks like JP Morgan and the likes, your asset managers. These people put in billions every day in the market. They have the big player. They're the one that the movers of market. They want to make the market move. Those big candles move. Those are institutions doing their work. So you want to be careful with them, and you want to trade with them. You want to trade in the direction in which they're trading. That's where you make big bags. So there are a lot of myths. So I can remember. At least with this one is good. Now the next thing I want to talk about is your expectation and the trading journey. What should you expect coming into this space? First, give yourself 6 months that you just want to learn. Just pure learning. You can make money at the side, you understand, but that shouldn't be your goal yet. 6 months to 1 year, yeah. Put in the work. Most of you go to university and spend years in university higher education, and you come out and you don't have anything doing for yourself. But you cannot give that time to trading that can actually change your life. I can give you the Lambo lifestyle. No, that's wrong. So that's what you should expect in trading. Put in the work for 6 months. 6 months to a year. Put in the work. They've already sell the space that there's another myth in trading that you just come here and you make quick cash. No, it's not done like that. You don't make quick cash in the trading space just like that. Yeah, you can scam people of their money. That's not trading though. So you scam them by telling them you're going to teach them this, you're going to teach them that you do broad marketing strategy. You bring in people and you teach them rubbish because you're not actually a trader. You're just an analyst. It's different. You can analyze the market doesn't mean you can trade it. They're two different people, as I said. So that's what you should expect. Give yourself time to breathe. You understand? Learn, practice, back test and forward test. Read books, finance book, try to upgrade your brain. This will actually help in your trading journey. 6 to 1 year, you want to practice. Then from 1 year, you're going to start making bags, You're going to start making bags in this market. You're going to start making bags in trading. You're going to count dollars. That's how it's done. So you want to make sure you're giving that time into actually learning the craft. Craft yourself well. Have it. The skills cannot be taken away from you when you learn it. You try to improve it every day, every time. If you feel you're backing down, you go back. You motivate yourself. Nobody ain't gonna motivate you, especially if you're a guy. You gotta motivate yourself into this. It's a beautiful space, but it's all messed up because of the scammers, because of the fake traders, people that are not actually trading. You want to be careful with them. So at least in 3 years and 4 years, you're gonna be a big boy. That's a good expectation in trading. You're gonna be well off. That I can guarantee you of. So these are the little things you want to make sure you pinpoint out. Why trading? Your psychology is paramount. Now, the last and most important psychology, I didn't write it down because it's so important. I should have written it down though. Is your relationship. Yes, I said it. Your relationship. I have many professionals come to me and be like, yeah, they call themselves professionals because they actually think trading for 3 years consistently is term professional because they learn everything in the chat, but they're not profitable. If you're not profitable, you're not professional. But they term themselves as professionals. Now they come to me and be like, they've been trading for so time, and why aren't they even making blog? What are they doing wrong? Is it that the space is just fake? But most of them I notice is from their relationship. The relationship lifestyle is poor. So poor. You can't just not have peace of mind in your environment while trading. You're gonna fuck it up. Because trading is gonna test you. It's gonna test your anger. It's gonna test your patience. It's gonna test everything you got. So if your environment is fucking you up too, you're gonna be all over the place, and you don't want to do that. So you have to make sure you have your relationship right. For the guys, make sure you're dating a reasonable girl, and for the girls, make sure you're dating a reasonable guy too. You know, put it in place, and actually know how to handle your relationship so it doesn't affect your trading. All this is psychology, indirect or directly. You might not know how it's affecting your trading lifestyle, but it's gonna do it. It's gonna affect it one way or the other. So you gotta be careful. You have to be careful with the type of relationship you build, especially if you want to be successful. So, with that being said, that is all about psychology tips. Okay, so welcome back. As I said, this class will be an interactive class. So I'll just be talking because I know you guys are new. So I'll just be talking, and your job is just to write down and listen. As I said, use your pace, you'll be able to understand it well. So now we are on trading view. So trading view is where you're going to be analyzing, where you're going to be doing your technical analysis. You understand? It's called trading view. You just download it. You can download the desktop version, and you can download the maybe Android or iPhone version on your phone. But I'm using the desktop version. Now, in TradingView, you analyze different assets. Now, there are different asset class, which I want to talk about. If you look to the left, these are different assets I can trade on. There are more, there are thousands, but these are a few that I like checking or trading on. Now, what do I mean by the different asset class? Now, if we're talking about Forex, which is foreign exchange, is the exchange of what? Money, currency. Look up here at this side. Let me as you can see British pounds and US dollar. British pounds and US dollar. That's a pair. This is called base, and this is called quotes. Quotes. That's QUOTE. They are pair. This is a pair, two currency together is called a pair. So this is the base and this is called a quote. You don't need that for now. Just know that. So this is under Forex because what is dealing with what? Foreign exchange. Exchange with one another. You understand? Now we have Euro USD, which is this one. Let me tap it. So as you can see, again, we have Euro and we have US dollar. So that's also a pair, but this pair is Euro and US dollar. So foreign exchange again, that's under Forex. So let's say Forex is the number one asset class I'm talking about, Forex. So under Forex, you have Euro USD and Great Britain USD. There are lots of foreign exchange pairs that you can talk. I'm only giving you these two. Now, the next asset class we're going to talk about is cryptocurrency. So we have BTC. So you're going to see Bitcoin and US dollar pair. You understand? Bitcoin and US dollar pair. Look, you have a look at this part. Bitcoin and US dollar pair. So this is what the base and this is the code. So we also have Ethereum and Tether USD is also US dollar. Tether is aligned with US dollar. So that's also under cryptocurrency, right? So number one, we have Forex. Number two, we have cryptocurrency asset class. Now, we have metals. Metals. Metals are your gold, silver. You can trade gold. As you can see, gold spot USD. This is the pair, gold spot USD. Metals are your gold and silver. We also have commodities, which are like your cotton, but it's not yet. Commodities, cotton, you can also trade that. And oil. I think oil is either in metals or I think it's under commodity. Oil should be under commodity. So let me look for that. I think I have oil here. Okay. US oil. We have UK oil. Now, you now have the popular one too, synthetic, which the asset under it is Boom and Crash, VIX, and the likes, VIX 75, VIX 100. So I'm just talking of that. Now, my most interesting one is indices. Indices. Now, indices are where you have the Dow Jones, which is known as US 30. So we have US 30, US 100, and US 500. Those are under indices. Now let me recap in case you got confused. We have Forex, we have crypto, we have metals, we have commodities, and we have indices. Indices are my most favorite pair to trade. So if you come here, so this is US 30, also known as Dow Jones Industrial Average, US 30. You can see it at the top here. So we also have US 100 and US 500. I don't want to talk much on that. I just want to give you guys brief cap on that. Those are the assets you can trade. And another thing about psychology is most people tend to want to trade all at once. They just analyze. Yeah, call yourself a trader, know how to analyze any market. But as I said, be master in one. So you want to stick to one while learning. You understand? You want to stick to specific asset while learning. So maybe if it's you, even I didn't say asset class. I said assets. Meaning if you want to only stick under indices, if you want to stick to US 30, just stick to only US 30. Practice this way for like 1 month. Then if you want to switch, you can switch to another. You can go to Forex, go to Euro USD or Great Britain USD, or you can go to crypto, BTC, but stay there for long. Practice it, know the market, feel the market. It will help your psychology. Most people that are struggling with psychology are everywhere. Everywhere. They want to do that, they want to do this. You understand? They are not sticking to one asset. So if I'm your mentor, if I'll be the one teaching you, we'll mostly be on US 30 most times. That's when I used to explain. But that doesn't mean you stick to that. No. After you learn what you want to learn from me, you can go on and pick any asset you want to specify on. These are the little things an analyst or a gambler cannot teach you. It's only a true trader that has actually eaten that button and that is already successful, that has gone through the grind, that can teach you this. Now, just looking at the trading view generally, looking at it, I know you're saying this. You'll be asking yourself, what is that? This is called time frame. It's called what? Time frame. Now, we have the 1 minute time frame, we have the 3 minute time frame, we have the 5 minute, 15 minutes, 1 hour, 4 hours, day, week, and months, and years, like that. Now, if you remember when we're talking about the forms of trading based on time period, when we talked about the intraday, the swing trading, and the position trading. This is related to that because if you're doing intraday trading, you want to just stick to the 15 to 1 minute time frame. If you're doing the swing trading, so you want to stick to 15 to the day time frame. You understand? So what does this time frame mean and how is it relating to the candle? What it means here is it took 24 hours for one of these candles to form. So let me zoom it so you can see it. Sorry about that. It took 24 hours for each of these candles to form. Each, just one candle. It took 24 hours for one of these candles to form. One. So if I go down to 4 hours like this, what is trying to tell me that it took 4 hours for one of this candle to form. So if I go down to the 1 minute, it's gonna be all off because we're in like small time frame now. So what it means, it took 1 minute. So this candle was forming. It took 1 minute for it to form. Let's see if there's any life. Okay, the market is closed. Okay, no. So there's an example. I want you to take note of the time that's reading. It's reading 15 minutes. Keep on looking at it. So 6, 5, 4, 3, 2, 1. So it's done with this candle. It opened another new candle now. Can you see? So it's going to count again. So this candle is going to take 1 minute to form. Are you understanding me? So if we go to 15 minutes, it's going to also have a timer. Let me delete this so you don't get confused. Sorry. So you see, it's taking it 9. It has 9 more minutes for this candle to form. It's going to take 15 minutes. So that's what that is all about. Sorry, time. I'm trying to find my way out. Okay, so that's how that is all about. I'll be talking more on the candle specifically, so you don't have to rush. And what again? These are the tools. These are favorite tools. I'm trying to just talk more on the trading view so you can understand some stuff on it. So these are the tools you're going to be using. So how did I get this here? It's just by clicking this, clicking it like this, and the one you had your favorite, because of there are much, so you just pick the one you if you put favorite, you see. Look at it. Just look here. So if I take it off, it's out. So if I add another one, it's here now. So if I don't need that, I just take it off. So the ones I need, now I don't have to keep on clicking here or something like that. I'm good with all this. So these are my favorites that I use more to analyze the market. And what again? We have the x-axis and the y-axis in the trading view, even doing technical analysis. So we have the x-axis, which will give you the time, and the y-axis, which will give you price. Now, even in mathematics, your x-axis is more important than your y-axis. because it's your x-axis that will actually give you your y-axis. If you go to maths in school, for those of us that like mathematics, it's the same thing with learning ICT. It's time first, which is this. Here it's giving you time. Here it's telling us about time. So it's time first before price. Time first before price. Don't worry, don't rush yourself. You're gonna learn more about that as the class progresses. So next we'll be talking on the candles, treating a bullish candle and a bearish candle, explaining the psychology behind each candle and what they mean. Okay, so as I said, in this episode, we'll be talking about this um, buy candle or the bullish candle and the bearish candle. So the anatomy behind each candle. I know you've seen some charts for the new traders. Talking about the new traders, you've seen some um, blue, a green candle and red candle, their movement up and down, and you're asking what the meaning of that. Well, I'm talking of each of those candles now. So we have a bullish candle and we have a bearish candle. So what's the bullish candle? The bullish candle is that's why it's green. Um, Meaning is bullish from the word. It came from the word bull, like the animal. Bull have this horn that is facing up, meaning the candle is actually going up. You understand? Is when market is actually bullish, when market is actually going higher. So that's when you have a bullish candle. But this is from the word bearish. That means when market is going down, a bear is always facing down, his face is always facing down. That is where the word bearish comes from, a bearish candle. Now for the bullish candle, you can also call it buy candle or long candle sometimes. While for the bearish candle, they call it sell or short candle. You can also use it in different form. I just wanted you to know about it. Now, for the bullish candle, as you can see, we have the open here. So this is called body. This is called body. While the extended the extended line is called wicks. W-I-C-K, wicks. W-I-C-K-X, the extended one. Now, the body is the main stuff. And there's a saying in trading, the weak do the damage, the body tells the story. So, in the bullish candle, you have the open, then price goes up and close above. While in the bearish candle, you have the open here, price goes down, then it close below. So, but the low and high for the two candles are the same. That means this is the low of the week and this is the high of the week. W-I-C-K, week. While for this is the low of the week and this is the high of the week. The same thing. The only difference is the bullish candle is having the open below while the close is above. Because it move up. While the bearish candle is having the open above and the close below. Now, the psychology behind this is just your normal economics. In the market we have buyers and sellers. So for the bullish candle, the 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 psychology behind it is that the price open at this level. So when we mean by price open at this level, we're relating it to the x-axis, the y-axis, sorry, this level. So we're relating it to the y-axis, so the numbers there. So let's say this level is at 38770. I'm just giving an example. So we're trying to say price open at that level. So after price open at that level, sellers came into the market to force price lower. Then at this level, buyers came back into the market and pushed the price higher to this point. Then seller was like, no, we want this candle to end in bearish. Then they started pushing the price down, but um, before you know it, time is over. That is the time frame on which that candle is set is over. So if you set in 5 minutes, 10 minutes, 15, hour or the like, um, through the process of them fighting, let's say we're on the 5 minute, this is where the 5 minute end. So they had to close here, meaning what? The buyers won. Because what happened is what? Price open here, sellers push it to this level, buyers push it high to this level. Then what happened? The sellers came into the market again and pushed it down here. But they were not able to push it lower than this open. They only were able to stop here because of the time factor, and the candle end in bullish, meaning the buyers won. Now for this candle, the sellers won. What happened? The price opened at this level. So after price opened at this level, buyers came into the market and pushed it higher. Then sellers came into the market and pushed it lower to this low. Then buyers came into the market again trying to push it higher for it to close above this open, but no, the time factor was already clicking and was already over. Then now they had to close at this low. So sellers won in this candle, and that is why it ended up a bearish candle. So that's what you want to take note of. Why in trading this is very useful. So that is the psychology behind each candle. The green candle and the red candle, you always see them in different charts. So if we're talking of, let's move that. So we're having what? Now I'd like to change my colors. That is green and red. It shouldn't confuse you. It's still the same thing here. So in this, the white one is my bullish candle, while the blue one is my bearish candle. As you can see, if price is going higher, we're having more white candles, right? Few candles down. Then next is what? If price is going lower, we'll be having more of the blue candles than few that's going up. You understand? So when you're seeing this type of movement, this is called an uptrend. When price is going like this, called an uptrend. While if it's the reverse, this is called a downtrend. So we have uptrend and downtrend. Then we have when prices sorry. We can have when price is consolidating too. Consolidating is when price is moving in a certain let me change this color. When price is moving in a, it's not actually going up or going down, it's just moving in, staying in one range. So let's say this. So you can call this price is consolidating. You see, it's not actually moving up and it's not going down, it's just moving sideways. So when price is moving sideways, we call that consolidating or ranging. Price is ranging. Most times you can also term it as accumulating. So accumulating, ranging, or consolidating, they're also saying the same thing, meaning price is moving sideways. way. It's not actually going up, not going down. So we have three phases that what ranging uptrend and what downtrend. Ranging, which is this, then uptrend, finally going up, then downtrend, which is what finally coming down. You want to take note of that. Very, very important. Then the next thing you want to understand in this trade, or in understanding the candles, are let's say taking a trade. So remember I said the whole trading is about learning, is price going to go up or is price going to go down. So let's take an example. Let's say you want to take a buy trade or a long trade or like a bullish trade. You calculated that at this level price will actually start going up, or maybe at this level you were able to predict that price will start going down. So you put in your, let's say let's do for short position first. So we predicted that price will start going down. So you pick this your tools, and let's say we are entering at this point. Then we'll put this here. I just want to give you an example. This is a short position tools. This. So what I just did is, for instance, what I'm trying to say is, this is a short position tool. That's what I'm going to take note of first. Now, what I'm trying to say is, I entered at this point in the trade. So I entered the market at this point. I put my stop loss at this point, and I'm taking profits at this level. Let's say this level. Or we can target this low. As I'm taking profit at this low. Now, what did I just do? The meaning of what I just did is, I'm risking, there's something called risk to reward. So I'm risking this to get this. So this is risk and this is my reward. This is risk, this is my reward. Let me give you an example. So let's say in my account I have $100 and I just want to risk $10 in that account. So I'm putting my entry point here and my stop loss here. So if I entered here with $10, which is, you do that on MT5, I'll also be taking you that. So let's say I enter this level at $10. I enter with $10 in the market. I VIX $10. What I'm trying to tell the market is, if it goes higher, I'm predicting the market will crash from this level. You understand? So if it starts crashing from this level, my $10 will start increasing. So my $10 will go, let's say at this level it will be at $20, and at this level it will be at $30. So I make 2 times the money of what I VIX. So if I enter this level at $10 and price start, and I said okay, price will start crashing, but instead of price start crashing, it started going higher. So it started forming this bullish candle. I'm giving you an example now. So if price started going higher, let's say like this, I'll be losing from the $10 that I VIX. So what I'm trying to say is, when price get to this level, just take off my $10. Don't allow me lose more. Remember, I'm using like a $100 account. So, but I want to only VIX $10. So meaning if price get to this level, I was wrong in my analysis. When you get to this level, before it goes higher and make me lose all my $100, just take off the $10 from my account. That's only what I'm willing to VIX in this trade. Because I told you, you are predicting the market, so you don't actually know where price we go is like betting. Just that betting is more reckless because you don't have any history or how will I put it, candlestick to tell you the story of what might happen. But in trading, you have the candlestick to tell you what will happen in the future. So we use the past candlestick to predict what will happen in the future. So if my prediction was wrong, I'll be losing the $10. If my prediction was right, I'll be making extra $20 on the $10 that I risked. I'll be getting out of that trade with $30 total. So my account has gone up to about $120 because I was right in my prediction. You understand? I was right in my prediction. I predicted it right. So this is what we call a short trade because price went down. You understand? Because I predicted that price went down. So this is what I call a short trade. So you have your stop loss here, which you can also call XL, stop loss. Then we have your entry point, which you can call EP. Then we have your take profit, which you can call TP. Meaning take profit. I want to take profit at this level. Don't worry, if price even goes lower, it's not my concern. Just this low, I'm okay to take my profit here. I'm satisfied with that. Meaning if price, the stop loss means if price goes against me, I want to get at this level, stop loss. So stop my loss. Stop my loss. I don't want to blow my account. I don't want to lose all my money. Just stop my loss. I'll have to do another analysis in the future and see if it will go my way. So entry point is the level you entered the market. So this for what? A short position. So we can also have for a long position. So you bring in the tools. So let's say this is a long position. Another example. So let's say we are entering a long position around here. This is our entry point. So we're putting our stop loss, let's say at this low. And we're targeting higher. Let's see where we can target. So let's say we're targeting this high. So what I'm trying to say here is at this point I entered the trade. You understand? I entered the trade at this point. Entry point. This is my entry point. So I'm predicting that price will go higher. You understand? Price will go higher. So if I enter this point, let's say for example again I'm wasting that same $10. As I enter this point, I entered a long position. So I'm trying to tell the market I believe you will go higher, so you make me more money, and when you get to this level, you get me out of the market. So what I'm trying to portray to the market is, in case you go lower, in case my analysis was wrong or my prediction was wrong, meaning you get me out. I want to just fix that $10 to this level. You get me out of the market. You understand? You get me out of the market. I don't want to lose more than that. Now, if it goes up as predicted, I'll be making more money on that my $10. So this is my risks and this is my reward. You understand? I'm risking $10 to make a reward of, let's say, $30. You understand? So I'm entering here, I'm putting my stop loss here, and I'm putting my take profit here because I predicted a long move. So a bullish move. I predicted market is bullish. So market will actually go higher. So you want to take note of that. Now, just these tools can give you enough of information. As you can see risk to reward ratio. Let me sign so you can see what I'm trying to say. It's around here. Sorry. Now this is showing you risk to reward ratio. As you can see, it's putting 4.28. What it means that the $10 you are making here, you are making 4.2 of that dollars. So it will be 4.2 times 10. So you're making about $40. So it will make the math more easy for you. If you are risking, so the risk to reward ratio will be 1 to 4.2 risk to reward ratio. So every $1 I'm risking, I'm making 4.2 of that. For every $1 I'm risking, I'm making 4.2 of that. So if I'm risking then $10, that will be times 4.2. That will be almost $42. Do you understand? So that's what this information is telling you. You understand? So for this is um telling you in pips. You understand? But I'll be explaining that in the future, how to do it manually, how to calculate it manually. But I will be starting with the Forex. I'll explain the Forex one. So there's something called pips. How to calculate your pips. So what is pips? Your pips is just okay, I think I didn't give you the definition for risks and reward. So for risks is telling you what you stand to lose in the market. Risks, what you're risking. While reward is telling you what you stand to gain in the market. So for pips is like how you calculate the market movement. So you want to know how much you are risking or how much you are gaining. That is what we call pips. The momentum in which the market used to move. You understand? The movement of the market. That's what we term as pips. If you want to know what you're going to be making and what you're going to be losing, the pips will give you that easily. So not mostly you don't want to calculate Dow Jones in pips. Dow Jones I'm talking of the indices, you calculate them in handles. You understand? You calculate them in handles. You'll be able to understand them more. So pips is how we measure the market. You understand? It's for the market movers, how the market moves. Then lot size, there's something called lot size that we actually determine how much you can risk and how much you stand to win. Those are like the mathematical part in which I'll be explaining in a bit. Okay, welcome to Learning Trade. In this episode, we'll be talking about pips, how to calculate your pips, lot size, and in the other section, I'll also teach you how to calculate using it. You know this Forex using crypto and gold, and then indices. That's another type. Is not calculated in pips. It's calculated in handles. I'll also be teaching you that. But in this section, we'll be talking about uh, pips, how to calculate pips. So we are in EURUSD, and if you can see, I just put in a short position. Now this is my entry point. You understand? This is just an example. It's not that I'm taking the trade. This is my entry point, my stop loss, and my take profit. And this are the numbers here. You can check it. You understand? You're correlating with this. So to calculate your wicks, that's what I'm wixing here. To calculate it is your entry point minus your stop loss, which is 9 pips. Now, to calculate your reward will be your entry point minus your take profit, which is 23 pips. You can do the math. So what you're doing, you're ignoring this. So, and ignoring this since they are alike, then what you're taking note of is just 845. minus 854. That will give you 9. Then 845 minus 822. That will give you 23. You understand? So after that, you have that's how to calculate your pips. You understand? Your weeks, you're mixing 9 pips, and your reward, you're mixing 23 rewards. Now, how can you convert this to dollars? Because, of course, you don't understand this. How can you convert this to dollars? To convert this to dollars, you must understand what lot size is. Now, lot size is going to be in your MT5. Now, it depends on your account size. That depends on the type of lot size you want to put. So the smallest lot size you can put is 0.01. Now 0.01 is equals to $0.1. So what you're doing is just moving this decimal point to this place. You understand? Just move it from here over to the 0, and that'll give you $0.1. So this is lot size. You understand? It's what you're going to, it's on your MT5, MT4. Now this is 0.02, the second lot size you can put. So you can, if you flip it here, that'll be 0.2, right? Dollars. Now if you are putting $0.1, that will be what? If you flip it here, that'll be what? $1. When you flip this here, that is what? $2. Now you're having 0. You understand? You need to be 0.1. Sorry, that's it. It's supposed to be 1.0. So when you flip the 1 over here, it will be $10. You understand? So if you're having 2 will be $20. That's just how. Now, in order to convert these pips to dollars, what you have to do is times 9 times, in case you're putting 0.1 lot size on your MT5. So 9 times 0.1. 9 times 0.1 will be what? That will be $0.9. So you are risking $0.9 if you enter with a 0.01 lot size. After the math you did, you will just be risking $0.9. But your reward, in case the trade goes to your place, well, your reward will be, that is 29 times what? 0.1. That's what? $2.3. So you'll be making $2.3 on this trade if it goes your way. You understand? So that is how you convert your pips to dollars. So weeks will be risking 0.9 because we're timing it, since we are using, why using 0.01 lot size. Since you're using 0.01 lot size, take note of that. So if you are using 0.1 lot size, that means you'll be doing $1 times 9, that'll be $9. Or $1 times 23, that'll be what? $23. So you are risking $9, making $23 on 0.1 lot size. But if it's 0.01 lot size, it will be $0.1 times 9, then $0.1 times 23. So that is 0.9 or $2.3 on this particular trade. So that's how you convert your VIX and reward to dollars. Now, when you're talking of ratio in mathematics, 1:2, 1:10. Now, if they're saying risk to reward ratio, what they're meaning, they're just telling you to divide your reward. Take note of that. I'm not going to type it. You divide your reward, which is 23, divided by 9. You get 2.5. So this trade now, you understand, is 1, which is the ratio 2.5. Do you understand that? So meaning for every loss that I take, I'm making 2.5 in this trade. So that's where you get 1:2.5. So you do 23, your reward divided by your VIX. Any digit you get, that is your ratio. So the ratio for this, the risk to reward ratio for this trade is 1:2.5. So thank you. The next one will be talking about handles, now to understand it. Welcome. In this section, I'll be teaching you how to calculate your pips on US 30, which is at the indices, and I'll also teach you how to calculate on gold. So it's very easy. The difference between this part and this part, when you minus it, your answer, you multiply it by 10. That will give you your pips. When you multiply this minus this, that will give you points, because indices are mainly calculated in point, or you can call it handles too. So when you subtract, this minus this, what you get, you multiply it by 10. That will give you your pips. So what you get is called points. The answer you get by subtracting them from each other, that's called points. But you have to multiply it by 10. That will give you your pips. Now, you can also use this to call price range. Instead of stressing yourself, you just put it from here to here. Now this is giving you 226.5. This is giving you point. So 226.5 times 10, that would be 2265 pips. That's your pips. That is as easy as that. You can also use your long and sell position. So as you can see, it's having 226.5 here. It's giving you what? Your point. So that point, you multiply it by 10. That is your pips. Is as easy as that. The same thing with gold. So you can see gold is having what? 27, right? So this 27, you multiply it by 10. That is giving your pips. That is 270 pips. You can also use the 2. Come in. If you want to get the 2, you can go here. Then price range. Let me put it in favorite. So I'll call it from here to here. As you can see, 27.3. Same thing with this. So you multiply it by 10. That will give you your pips. It's as easy as that. You can use your price range for any asset. It's more quicker and friendly. You do it more easy and you don't actually waste time. Or you can just get it from this. You understand? From your position, your long or sell position. You just concentrate on this. So you multiply the points that you get by 10 and do the same thing for the stop loss too. And that will give you your pips, and you can relate it with your lot size, and you know how much you're fixing and how much your reward is. That's all. So that will be the end of this video on this beginner's guide to Forex. So I hope you have a wonderful trading career. Take care of yourself and have a nice day.